Hey there, Brad Castro from GreatOptionTradingStrategies.com. As a 25-year veteran of option trading, I can tell you that getting an early assignment on in-the-money short put trades is one of the most misunderstood aspects of option selling. Not only does the issue confuse a lot of traders, but it also causes unnecessary anxiety. It's like a lot of traders have this pervading fear, some big fist in the sky, ready to smash down on them like a hammer the second their short put trades in the money. And then what will they do? At the same time, there's another group of newer traders who have been lulled into a false sense of security by the wheel strategy. No worries, they say. If I get a sign, it's no big deal because I'll just start selling covered calls. But as we'll see, all that does is mask the problem, not solve it or progress your trade repairs. But good news, in this video, we're going to eliminate all confusion and anxiety around naked put early assignment, and you'll be ahead of all the other traders who continue to be baffled by the early assignment process. Even better news, I put together a free 24-page complete guide to early assignment that covers all aspects of the assignment process. That includes what early assignment is, why it happens, and how you actually get selected to be assigned, how to avoid early assignment, what to do if you are assigned, and why the wheel strategy leaves you stranded. I've added a link in the description section, along with links to a ton of other free option trading resources, and in the pinned comment below. Now, I didn't want to turn this video into a 45-minute webinar, so consider this to be an abbreviated version of the early assignment guide. Don't worry, we're still going to cover the essentials here, but if you want the comprehensive version where I'm able to go into a lot more detail, especially the process I call unassignment, as well as why the wheel strategy may not be the solution you've been told it is, then you might want to download the guide. Okay, let's get started. Part 1, what is early assignment and how and why it happens? First, just to make sure we're on the same page, here's a quick summary of naked/short/cash secured puts in assignment. Selling or writing a put generates a cash payment called premium in exchange for you agreeing to purchase 100 shares of the underlying stock if the stock is trading below the strike price of your short put on the expiration date, or before the expiration date if the holder of the put exercises it early. If the stock is below the strike price at expiration, assignment is automatic and you will find come Monday morning that you own 100 shares at the agreed upon strike price for each short put contract assigned. The person long the put that you wrote or sold, however, is under no obligation in the U.S. markets to wait until expiration to unload his or her shares, and in fact can exercise that put at any point, resulting in early assignment for you. Now, just because a stock falls below your short put strike price, the definition of an in-the-money short put, that doesn't mean that you're at great risk of early assignment. In fact, once you recognize the limited scenarios that do in fact increase the odds of early assignment, you can relax a little and just monitor your trade, taking action only when the situation warrants it. And the first thing that should reassure you is the fact that not every put option purchased is done so by a stock owner. Just because you sell a put, it doesn't mean that person on the other side of the transaction owns any shares. Now, I also don't want to give the impression that assignment involves a one-to-one ratio between put seller and put buyer. Obviously, there are market makers who handle the bulk of the trades. So in effect, when a put gets exercised, the put writer who gets assigned is randomly chosen. I compare it to a kind of lottery that you may not be all that excited to win. But the vast majority of open market put purchases are done so as a speculative bet on the direction or behavior of a stock, not as an actual protective put by an actual shareholder. As such, when someone long the put decides to close out his or her position early, that trader will therefore most likely just sell to close their long put position rather than exercise the put, which obviously wouldn't make sense if the trader didn't own the shares in the first place. Now, market makers are a different story. It's likely that they're going to have all sorts of different stock and option positions on at any given time in order to square their positions and avoid exposure to directional moves in the stock. Remember, they make money from skimming a little from each transaction, not from directional moves, which also means they need to insulate themselves from those directional moves. So if and when you are assigned on a short put position, there's a high likelihood that it was a market maker who did it to you. The good news is that market makers are capital efficient and rational. They're not going to exercise a long put and unload their shares on you willy-nilly. They're only going to do it when it makes financial sense to do it. And in the next section, we'll look at the only time a professional market maker will exercise a long put. Part 2, how to avoid early assignment. Okay, here's where we completely demystify the early assignment process. There's that famous scene from the 1967 film The Graduate where Mr. McGuire pulls Dustin Hoffman's character aside and tells him, I just want to say one word to you. Just one word. Plastics. In the same way, if you want to avoid early assignment on your in-the-money put selling trade, I just want to say 3 words to you. Just 3 words. Remaining time value. It doesn't matter how deep in the money your short put is, i.e. how much below the strike price of your short put the stock is currently trading. It's only when the remaining time value in your short put is gone, or essentially gone, that you're at risk of an early assignment. It also doesn't matter how far away expiration is, whether it's 3 days or 3 months. If your short put still has time value left on it, it's extremely unlikely that you're going to get assigned. But once the remaining time value gets down to fumes status, you're vulnerable to having the shares put to you. Now, inside the Naked Put Early Assignment Guide, which again you can download via a link in the pinned comment below or in the description section, I include a really good illustration of why this is via an in-the-money short put trade we had on Gilead inside the Leveraged Investing Club. I walked club members through it at the time and added it to the early assignment guide because it really is a good example that you can see with the actual numbers. But the short version is that if a trader has a long protective put and wants to unload his or her shares at that strike price, but the long put still has time value on it, they'd be crazy to exercise the put. They'd be much better off simply selling both the shares and the long put, because that way the remaining time value would be added to the proceeds of the unwind. If you exercise a long put, if there's any remaining time value on that put, it basically gets flushed down the toilet, where you could have sold it back and walked away with more total dollars. Okay, let's look at early assignment scenarios. In Ernest Hemingway's The Sun Also Rises, there's the famous quip when a character is asked how he went bankrupt. Gradually and then suddenly. In a similar way, those are the 2 ways that remaining time value can zero out or come close to it on an in-the-money short put. Through a combination of weak price action and the passage of time, remaining time value can dwindle away until it's down to virtually nothing. But there are other instances where the stock takes a big sudden move lower and the remaining time value is pretty much gone all at once. Monitoring your in-the-money naked or short put position is always a good idea in case your trade slowly creeps in this direction. But there are a couple of other big event type occurrences you'll definitely want to pay close attention to. Big event number 1, an earnings release, especially when the market is disappointed after the fact and there's a significant drop in the share price. In such a situation, the time value on a put takes a double hit. The first hit is that much of the elevated levels of implied volatility is expended once the uncertainty of the earnings has been resolved. And second, in the case where the share price drops following the earnings release, the deeper the put goes in the money, i.e. the farther the share price trades from your strike price, the less time value is included in the put's premium. And big event number 2, the ex-dividend date. Something similar occurs on the ex-dividend date, and the higher the dividend or dividend yield, the more pronounced the effect becomes. Recall that the ex-dividend date is the date on which purchases of the share no longer qualify you to receive that quarter's dividends. So if you own the underlying shares on which you also own a protective put, and you want to unload your shares, you probably wouldn't exercise your long put prior to the ex-dividend date because you'd screw yourself out of receiving the dividend. But on the ex-dividend date, all that changes. At that point, you're free to exercise the put, assuming the time value is gone, or almost gone, unload the shares at the agreed upon strike price, and still be able to look forward to receiving the dividends on the upcoming payout date. Also be aware of highly volatile days where the underlying stock really craters but then recovers to some degree. If the stock trades low enough that the remaining time value is gone at some point in the session, even if your short put picks up more time value later in the session on a rebound, market participants with protective puts may have exercised them earlier in the day. So the easiest way to avoid early assignment is to monitor remaining time value and simply roll or adjust your in-the-money short put when it gets close to zero. But that begs the question, how do you calculate remaining time value when it's not always easy to do so? Sometimes there are wider bid-ask quotes, and let's face it, sometimes it's just not fun or easy to do the math, even when you do have bid-ask quotes that are more narrow, because you have to determine how far below the strike price of the in-the-money put current share price is, and then deduct that from the current price of said put. In a low interest rate environment, there was a super easy and cool workaround for determining remaining time value on an in-the-money short put. You simply looked at the corresponding bid-ask quote of the call option at the same strike and expiration date. By definition, the premium available on an out-of-the-money call option at the same strike and expiration as your in-the-money short put is 100% extrinsic or time value. Unfortunately, there are a couple of factors that impact put and call option pricing a little differently: the current interest rate environment and the dividend calendar. I explain it in more detail in my covered calls and cash secured puts deep dive video. There's a link in the description below. But in the current interest rate environment where T-bills are currently paying around 4% annualized, you can expect, all else being equal, that call pricing will outpace put pricing by a similar amount on an annualized basis. Very quick and dirty rule of thumb, but what that means is if I can't easily determine the remaining time value on an in-the-money short put, if I see the time value on corresponding call options get down to around 25 to 30 cents a contract, I know it's time to start looking at my next roll or adjustment if I want to take the risk of early assignment off the table. Again, that's just a rule of thumb. It's not a total amount difference, but an annualized rate difference. So the nominal share and strike price you're working with matters. Part 3, what to do if you are assigned. Now, even among experienced traders, there can be a weird primal reaction to getting that email from your broker notifying you that your short put position has been assigned and that someone has forced you to take their crappy, beaten down shares. Or logging into your brokerage account blindly and seeing the same thing. It can stir up feelings of fear and anxiety and rejection, like you've somehow failed on the trade and are therefore a failure as a trader and a human being. But nothing could be further from the truth. At the very worst, early assignment is nothing more than a nuisance. But don't be lured into complacency by the wheel strategy or thinking that accepting assignment and now writing covered calls is your only choice. Because I offer you a superior tactic that I developed that I call unassignment. What I call unassignment is pretty straightforward. I simply sell back the shares I was assigned and then rewrite a new put, most likely at the same strike price but in a later expiration cycle. The later expiration date is important. If you set up the position identical to what it was, you're probably just going to get assigned again. Best way to view unassignment is as a roll or adjustment, although one that would have been a lot more efficient if you'd made it prior to having been assigned. Let's look at an example. Suppose you write a $30 put on a stock, receive a $1 contract in premium, and then the stock drops to $26.50 a share, either gradually or quickly, with a week or so to go until expiration. And then you wake up one morning to the dreaded notification that you were assigned the shares, most likely because you weren't paying attention to the remaining time value, which had largely disappeared. Now this table here is a quick example by way of illustration. You'll note that I'm assuming I can write a $30 put, which is $3.50 in the money, for $4 a contract. Maybe I can get a better price, maybe not. And maybe I can do this 1 month out, or maybe I would have to go out a little farther out. But if you take a moment and really consider this unassignment example, it's the same thing as having rolled that in-the-money short put straight out to the same strike price but later expiration cycle for a 50 cent per contract net credit. Structurally, unassignment functions the same as a roll. Again, unassignment involves selling the shares that you were assigned and simultaneously, although these will by necessity be two separate transactions, reestablishing a new short put position. And what should the new short put position be? Well, imagine you have a time machine and could go back 1 day before you were assigned. What roll or adjustment would you have made if you could go back? That's the new position you should try to establish. As long as the share price is more or less the same between the two transactions, selling the shares back and reestablishing the new short put position, all of this should function as a slightly inefficient roll or adjustment. So unassignment simply adds a step to the rolling process, selling the shares Mr. Market assigned to you right back to him. Also, once you've unassigned once, it will make a lot more sense, and before you know it, you'll become an old pro at it. Now, quick side note, inside the Leverage Investing Club, we use the proprietary 4-stage trade repair formula to manage and repair in-the-money short put positions. One key trade repair principle that we're very adamant about is that if your short position trades in the money on you, i.e. the stock trades below your short put strike price, your number one objective should be to work the strike price lower, providing you can meet these two conditions. Number one, you can do so for a net credit, i.e. collecting more on the new leg than it costs to close out the old leg. And number two, not have to roll out more than 3 monthly expiration cycles. It's very simple. The more you're able to work the strike price lower, the easier all future rolls and adjustments will be, and the quicker you'll be out of the trade, because the stock has to come back less. And the more net premium you collect along the way, the greater your final profits will be when you're finally out of the trade. So yes, you can keep unassigning at the same strike price, or roll out at the same strike price before that happens. But if you miss an opportunity to work the strike price lower while netting more premium on the transaction, regardless if that's the unassignment process or if it's rolling down and out for net credit before all the time value is gone, the harder it will be to repair the trade. Incidentally, that's where the wheel strategy's false sense of security comes in. Part 4, why the wheel strategy leaves you stranded. At the time I'm putting together this video, I'm also working on a deeper dive special report into the wheel strategy's many inefficiencies and small handful of actual dangers. So be on the lookout for that. But in the covered calls and naked puts video I referenced earlier, again, there's a link in the description below, one of the key points I made was that covered calls and naked puts are essentially the same trade, just structured in different or inverse ways. Said another way, they produce the same outcomes and generate essentially the same returns, but not 100% identical. As I mentioned earlier, the dividend calendar as well as current interest rates impact pricing of calls and puts differently. Once you understand those differences and once you take into consideration your own personal situation, it's pretty easy to determine whether structuring your income trades as covered calls or as cash secured puts is in your best interest. So there's nothing inherently wrong with allowing and accepting assignment of an in-the-money short put and then managing it and repairing it as a covered call. I've done this myself on trades where the underlying pays out a solid dividend, and I feel that the trade will return more by me holding the shares. But the problem with the wheel is that unless you really understand that covered calls and cash secured puts are the same trade, and unless you understand the importance of working the strike price lower for net credits, you're at risk of being whipsawed. And not just in one way, but in two. Risk number one, what I call the reckless whipsaw. Let's say you get assigned at the $45 strike and you decide to accept assignment and now start selling covered calls. What strike price are you going to go with? The same $45 strike? Since your short put was assigned at that strike price, there's a good chance there won't be a whole lot of premium available at that covered call strike the next month out. So maybe you'll be tempted to cheat a little bit and write your next covered call at a lower strike. And then, boom, some unexpected good news hits and the stock blasts higher. Congratulations, now you're underwater on your covered call. And if you're unable to work your covered call strike back to the original short put assignment strike price, that's an unrealized loss now or a realized loss later. And then there's risk number two, what I call the partial whipsaw, or what about the break even? Now, a lot of wheel traders who haven't yet been worn down by the mechanical nature of the strategy will say that it's perfectly okay to sell covered calls at a strike price below the assigned put strike price, just as long as it isn't below the break even of the trade. For instance, going back to that $45 short put assignment example, let's say that you've collected a total of $6 in accumulated net premium to date. Let's suppose you sold the $45 put and then rolled it 2 or 3 times for more net premium before the stock sold off. And now the stock is trading at $35 a share. Selling a $45 call at that point, even going out 3 months, still may not bring in any meaningful premium. Now, if you could sell a $42.50 covered call for $2.50 a contract or more, that's a different story. As we saw earlier, that's equivalent to rolling an in-the-money $45 naked put down and out to the $42.50 strike for a net credit. That's a very good move, in fact. You worked the strike price lower, and while you probably didn't bring in much new net premium, the important thing is you didn't have to give back any of the accumulated net premium you previously brought in. But the break-even crowd has a convenient workaround. As long as you write covered calls at a strike above your break-even, even if it's below the strike price at which your short put was assigned, no matter how high the stock trades at that point, you can't lose money on the overall campaign. While that may technically be true, there's a serious flaw in the logic. Let me explain. In a hypothetical example, if your $45 short put is assigned, but you've racked up $6 a contract in accumulated net premium over multiple rolls, your break-even is $39 a share. The $45 assignment price less the $6 of accumulated net premium. So that means you could sell your covered call at the $40 strike price, and no matter how high the stock trades, if you're forced out of that $40 strike, then you're guaranteed to still walk away with profits. But if the stock does rebound strongly, those profits just got a whole lot smaller, as you have to give $5 a contract of accumulated net premium back to Mr. Market. True, the campaign was still profitable, but having to give back some, much, or even most of what you previously racked up is still a form of being whipsawed. Finally, when the wheel encourages traders to keep flip-flopping back and forth between cash-secured puts and covered calls, what it's really encouraging is a lack of strike price discipline. And without discipline and clarity, I would argue that actual trade repair progress is haphazard at best. Determining your cost basis or break-even is hard enough with all the back-and-forth trades. But even worse, the wheel strategy doesn't even try to measure what I call the true exit strike price, because it doesn't even have a conception of what that is, in fact. But that's a more in-depth conversation for another day in the upcoming Ditching the Will special report and future YouTube videos. Bottom line, there's nothing inherently wrong with allowing assignment and managing or repairing the trade from the covered call side, as long as you understand and maintain strike price discipline. Okay, to summarize, congratulations, you're now an official expert in the naked put assignment process. I kid you not, I've witnessed firsthand even experienced put sellers express surprise when they were assigned early, simply because expiration was still quite a ways away. But one glance at the option chain and mystery solved, there was no remaining time value. So it's very simple. If you want to avoid early naked put assignment, roll or adjust before the time value is gone. And in the event that an early assignment sneaks past you, it's not a big deal at all. Simply unassign by reestablishing a new short put position that corresponds to the roll or adjustment you would have made the day before had you actually made it. Or if you prefer, keep the shares and manage and repair as a covered call position instead, but only if you're completely clear on where your true exit strike price is. Okay, let me know in the comments if you have any questions about anything or if something's not clear. And I really recommend you download the full Naked Put Early Assignment Guide, as it includes more information than I was able to squeeze into this video. And it's a nice permanent resource for you as well. In fact, if you check out the description section, I've got a lot of option trading resources for you and a free newsletter you might find useful. These are resources for you if you sell options for income, or even if you're either a value investor or a dividend growth investor and want me to show you some really smart ways to incorporate options into your portfolio to dramatically improve your investing results. Also, be sure to check out the channel's other videos. Everything's organized by playlists, and I'm actively adding new content and have a backlog of new ideas I'm putting together. Okay, until next time.